Welcome back to the deep dive. We are here to give you the ultimate shortcut, taking these complex, often, overwhelming sources on technical analysis, crunching all that data, and delivering the essential foundational strategies directly to you.
It's so true.
Because if you've ever tried to tackle technical trading, you know the drill. You stack your charts with a dozen colorful indicators, only to realize you still don't truly speak the market's core language.
That is such a critical observation. And we actually saw a fantastic reflection of this in the source material. It was a seasoned trader admitting they had been active for like years without truly grasping how to use volume effectively.
For years. Wow.
Yeah, not just the basic concept, but the granular bar-by-bar comparison that, separates a high probability setup from just random noise. That realization that the simple, fundamental tools are often the most misunderstood. Well, that's precisely our mission today.
Okay, let's unpack this. We're doing a comprehensive deep dive into technical analysis TA and using our sources to build a foundational step-by-step masterclass. We're going beyond just definitions here.
Way beyond. We're providing the data behind why certain indicator combinations and risk management structures just work better than others.
So what is technical analysis for anyone who's just dipping their toes in?
Right. So technical analysis is the method you use to predict future price movements based purely on past trading data.
Things like price, volume, trends.
Exactly. And this is often contrasted with fundamental analysis, which, looks at a company's intrinsic value, their performance management, that sort of thing.
And TA's big advantage is speed.
It's timeliness.
Yeah.
Fundamental data, like quarterly reports, is inherently lagging. It's often released months after the fact. TA, on the other hand, relies on real-time price trends and trading info, which allows for really rapid decision-making.
So our mission today is to synthesize the true language of the charts. We're diving into the core tools, moving in a logical progression.
A very logical progression.
We're starting with the absolute foundation of price action, that's support and resistance and trend identification. Then we'll move to essential confirmation tools like volume price analysis.
Or VPA.
VPA, right. Then integrating powerful momentum oscillators like MACD and RSI, looking at volatility with Bollinger Bands. And finally, the most critical part.
Yes. The part everyone skips.
Mastering the defensive game, exit, and risk management. So let's get started.
Okay, so before we can even begin to talk about support, resistance, or trends, we have to address the most fundamental visualization tool of all.
Okay.
The candlestick. I mean, since we're talking about drawing lines on charts, we need to know what those lines are even framing.
And that's actually where I need to start. Wait, what is a candlestick again? How do I even read one?
That's the perfect question. It's the foundation we have to build on.
Yeah.
So candlesticks, which were pioneered by a Japanese race trader, Manihisa Homma, way back in the 1700s.
Wow.
They're a specific type of chart that visually emphasizes the open-close relationship of price over a set period. Each single candle represents the entire price movement for that period, whether it's 1 minute, 1 hour, or a full day.
And the structure itself, I see these like thick blocks and then thin lines sticking out.
Exactly. The thick block is called the real body. And the color of that real body tells you the direction of the price during that period.
Okay.
In modern charting, usually a red or a black body means the price closed lower than it opened.
So a down period.
A down period. And a green, or sometimes white or blue, body means the price closed higher than it opened. The thin lines sticking out above and below that real body, those are called the wicks or shadows.
And they show the extremes.
The absolute extremes. They represent the highest price reached and the lowest price reached during that specific time frame. Understanding that open, close, high, and low, well, that's the absolute key to reading price action.
Got it. Okay, now we can talk about structure.
Let's begin where all successful analysis starts. Understanding structure. And structure is built on the interplay of supply and demand.
Which we see visually as support and resistance.
Exactly. Support is, simply put, the price floor. It's the level where buyers typically enter the market in enough quantity to prevent the price from falling any lower.
And
resistance is the opposite. It's the price ceiling, where sellers or supply step in to stop the asset from moving higher.
it really sounds like these levels reflect a kind of mass consensus. They aren't just, random lines we draw on a chart. They're real psychological barriers.
You have absolutely hit on the core issue. They are created by the aggregation of limit orders and market actions. It's where large groups of traders have decided a price is either a great bargain or, finally high enough to justify selling.
So how should I think about drawing them as a single line?
No, and this is a key point. You should always think in terms of zones or bands, rather than single precise lines. If you rely only on connecting the absolute lowest low, you risk having your buy order missed by a single tick.
Okay.
Viewing it as a zone is much more actionable and, frankly, much more realistic.
Okay, so support sounds like where the price bounces the floor. But how do I know it's real support and not just random noise? Is it just a matter of connecting 2 points?
That's a critical point you're raising about confirmation and validity. I mean, yes, you start by connecting the lows, but real robust support often aligns with psychological levels, like round numbers, $100, $50, that sort of thing.
Okay.
And most importantly, it should be tested multiple times. The reliability and strength of that support zone is directly correlated with the number of times the price has touched it or bounced off that level successfully.
So more bounces means stronger support.
Exactly. 1 bounce is interesting, 3 successful rejections. That signals a really powerful structural level.
Now, what happens when price does breach one of these powerful levels? That seems like it would be a major inflection point.
It absolutely is.
Mm-hmm.
And this brings us to the concept of SR flipping.
Flipping.
If the price breaks out strongly above a resistance level, let's say $100, that former ceiling is often retested and confirmed as the new floor.
So what was once the ceiling becomes the new floor?
Yeah.
I get it.
Exactly. When the price pulls back, traders look for that $100 level to hold as the new support. It flips roles. And conversely, breaking decisively below a strong support level often signals a potential trend reversal or a powerful move downward. These flips are very high probability entry points.
Okay, so once we have our SR zones, how do we define the trend? Is it some complex formula or is it purely visual?
Well, the efficiency of trend identification is that, initially at least, it doesn't require any complex formulas or indicators. A visual check of the market structure is often enough.
And what are we looking for visually?
We define trends by the relationship between the recent swing highs and swing lows. An uptrend is simply a repeating pattern of higher highs, meaning the market pushes up higher than the previous peak and higher lows.
Where the pullback stops higher than the last one?
You got it.
Oh.
The subsequent pullback stops higher than the previous valley.
And the opposite for a downtrend, I assume?
Exactly. A downtrend is just a series of lower highs where a rally stops lower than the previous peak and lower lows where the price drops lower than the previous valley. You're just looking for the market structure to confirm that momentum.
It always feels like the market is trending, but I hear the reality is far different. How often are we really in a confirmed trend?
That statistic is so crucial for perspective and, for avoiding bad trades. Research indicates that trends occur roughly 30% of the time.
Only 30%.
Only about 30%. The remaining 70% is either a ranging market, where the price is just moving horizontally between 2 defined SR levels, or a choppy market.
And choppy markets are bad.
Choppy markets, which are characterized by high noise and unpredictable whipsaws, should generally be avoided entirely by less experienced traders. Your analysis has to start with classifying which of those 3 environments you're in, because different strategies work for different market types.
Okay, final question on this foundational section. If resistance breaks, do I sell or go long? How do I tell if it's a real breakout or a trap? This is where I think a lot of novice traders, like me, would jump the gun.
That is where disciplined waiting comes in. I mean, when resistance breaks, the general impulse is to anticipate continuation and just jump in, go long.
Right, FOMO kicks in.
It does. But this is super high risk because of those false breakouts or traps where the price just snaps right back. The professional approach is often to wait for the pullback, or throwback as it's sometimes called.
So you wait for it to come back to the level it just broke.
Exactly. This is the move where the price returns to retest that broken resistance level, which should now act as the new support. If the price bounces off this newly established support level, that confluence signals a much, much higher probability entry than jumping in immediately.
So you confirm the SR flip before you enter.
You confirm the flip before you risk a single dollar.
Okay, that makes sense. Now let's talk about confirmation.
Right. So now that we understand price structure, we can move to the essential objective confirmation tool, volume price analysis, or VPA.
Okay.
Volume, simply put, is just the number of trades, the actual units of a stock or a contract or a currency that took place in a set period. It's the measure of participation, of conviction, and of the money that's backing the move.
We talked about that seasoned trader who was active for years and missed this core concept. It sounds so foundational, yet it seems like it gets overlooked for flashier indicators.
It does get overlooked, and primarily because many people treat volume as a standalone indicator. They just say, oh, high volume means a big move is coming.
And that's not the whole story.
Not even close. The real epiphany, as highlighted in our sources, is using volume as context by comparing the volume profiles between different phases of a price move.
Tell us more about that comparison, the impulse versus the pullback. That's where it gets really interesting.
Absolutely. So in any trend, you have two critical phases. The impulsive move, which is the strong push in the direction of the trend, and the pullback or retracement, which is the temporary, less decisive move against the trend.
Okay.
The VPA principle is this. If the impulsive move happens on high, convincing volume, but the pullback that follows occurs on weak or small volume, that is a powerful confirmation signal.
Why is that so powerful?
Because low volume during the pullback means nobody is selling with any conviction, or buying if it's a downside retracement. This lack of broad participation confirms that the initial trend push is likely to continue.
So the smart money is driving the price aggressively on high volume, and when the price corrects, smaller players aren't strong enough to drive that correction with high volume. That confirms the direction is sound.
You've nailed it. The low volume pullback suggests the large participants are just letting the market breathe before they continue the move. And this context is applicable across almost all major markets and works on various time frames, from a 1-minute chart to a daily chart.
Any practical tips for reading it?
Yes, a key practical note. You must always wait for the candle to close to confirm the volume reading.
Why at the close?
Because wicks can be so misleading mid-candle. You can see volume surge and then just dissipate, only to reverse completely before the period is over. The close is the confirmation.
I also know that successful traders often move beyond these simple volume bars. What's the next logical step once a trader masters this basic comparison?
Well, once you're comfortable reading simple volume bars and making that push versus pullback comparison, the next step is often diving into more granular tools like footprint charts or accumulated volume by price.
And what do those show?
They help you see not just how much was traded in a period, but at what price the volume actually transacted. It gives you a much clearer picture of order flow and supply-demand imbalances. But honestly, many find that keeping it simple with basic volume provides 80% of the benefit without the complexity.
Okay, let me ask the clarifying questions here. A volume spike confirms a bounce. But why can't I just follow price action alone? Price action tells the story, so why even bother with volume?
It's a great question. Price action is the ultimate truth, right? But volume acts as your objective filter. It confirms the conviction behind that price move.
So it's like a fact checker for the price.
That's a great way to put it. Think of it this way. Price might bounce off support, but if it does so on tiny volume, that bounce is suspect. It might easily fail on the next test.
But if the volume is huge,
If it bounces on surging volume that's clearly above the recent average, you have confirmation of strong institutional-level buyer participation. It just reduces your guesswork and increases the probability of a successful trade. It's an essential filter.
I sometimes see a small red candle with small red volume. It feels really obvious. Small candle equals small volume. What am I missing here?
That is the classic misunderstanding that trips up so many traders, even veteran ones. The crucial element isn't the size of the candle body matching the bar height. It's the comparison of volume to the average activity.
The average, okay.
You should be comparing the volume on the current bar to the average volume of the previous 3, 4, or maybe even 20 bars, depending on your time frame. A small candle with average volume is neutral. A large impulsive candle with significantly above average volume. That confirms the breakout strength.
So it's all relative.
It's all about relative strength. You want to see the participants surge when the price is pushing strongly, and then you want to see them disappear when the price is merely correcting.
That distinction comparing against the average, not just the previous bar, that's huge. Okay, finally, what about the big institutions hiding orders or using complex algorithms? Does that make volume analysis useless for us?
That's a legitimate concern. Sophisticated manipulation like stop hunting, where they drive prices briefly to levels with massive stop-loss orders just to create liquidity, that does exist.
So volume can be faked.
And not exactly. The simple volume indicator still reflects the overall collective buyer and seller participation in the market. Even with dark pools and high-frequency trading, the collective movement of orders leaves a volume footprint.
So the principle still holds.
The VPA principle of comparing push volume versus pullback volume still holds strong for providing valuable context, even if you're not looking at granular order flow data. Simple volume analysis is resilient because it measures the fundamental equation of supply and demand.
Okay, that makes sense. Let's move on to some of the more well-known indicators.
Right. So moving beyond pure price and volume confirmation, we enter the realm of oscillators. These are tools that typically run below your main price chart, and they measure momentum and identify overbought or oversold conditions.
And we're going to focus on two of the big ones.
The two most popular, the Relative Strength Index, or RSI, and the Moving Average Convergence Divergence, or MOTS-AD.
Let's start with RSI. It seems like the standard tool for telling me if something is too high or too low.
That's its primary job. The RSI is a price-based oscillator that measures the speed and change of price movements, generally using a 14-period window. The typical thresholds are really simple.
What are they?
An RSI reading below 30 is generally considered oversold. This suggests that downward momentum might be exhausted and signals a potential buying opportunity.
And above 70.
An RSI above 70 is considered overbought, suggesting upward momentum is stretched and signaling a potential selling opportunity.
That sounds incredibly straightforward. But, if it were that easy, everyone would be rich. What's the catch?
The catch, and you absolutely must internalize this, is that RSI thresholds can limit your profit when the market is in a strong, sustained trend.
How so?
In a powerful uptrend, the price can continue to rise significantly, even while the RSI remains stubbornly above that 70 overbought threshold for days or even weeks. This is called a failure swing or divergence failure.
So you'd be selling way too early.
Way too early.
Yeah.
Therefore, you have to use RSI with strong context. It only confirms a potential reversal when it aligns with an established support or resistance level, or maybe a Bollinger Band boundary. Relying on RSI hitting 70 alone as an automatic sell signal is a quick way to miss out on huge profits in strong trends. Got it. RSI is a warning light, not an entry trigger by itself. What about MACD? The MACD. It's one of the most powerful and popular trend-following momentum indicators. It's derived from moving averages and typically uses traditional parameters of 12, 26, and 9.
What do those numbers mean?
Well, the 12-period EMA often approximates 2 weeks of trading, and the 26-period EMA approximates a month. The MACD line itself is the difference between these two averages, which shows the momentum. The 9-period signal line is simply the moving average of the MACD line itself, just to smooth out the signal.
So it's really measuring acceleration and deceleration in the trend. I know our sources explored several ways to use the MACD. What are the key rules for entries?
Right. The backtesting research we looked at identified 4 primary signal rules. The most common is the classic signal line crossover.
Okay.
You buy when the MACD line crosses above its smoother signal line, and you sell when it crosses below. A second key strategy is the zero crossover.
And that is?
You buy when the MACD line crosses above the zero line. This indicates that the short-term moving average, the 12, has crossed above the longer-term moving average, the 26, which signifies a major momentum shift.
What about the more data-backed strategies from the research?
Well, the research highlighted that while a complex histogram rule provided the highest raw win rate, around 68% on the Nasdaq, its profit and loss ratio was often low because of small profit targets.
So you win a lot, but you don't win big.
Exactly. The strategy that performed better in terms of risk-return metrics was the signal line crossover above zero. This requires the MACD to cross above its signal line, while the MACD line is also above the zero line.
So it's a double confirmation.
It's a double confirmation. This combined strategy achieved a 59% win rate on the Nasdaq and offered a superior risk-adjusted return when it was optimized.
That's fascinating. So we have all these rules, but the ultimate conclusion from the sources was to use them together. Combining indicators like MACD and RSI hit an astonishing 86% win rate. Why does that confluence work so well?
That 86% win rate is overwhelming, and it really tells you the secret. Confluence eliminates noise. MACD measures trend momentum. It tells you the direction and strength of the move. RSI measures exhaustion.
It tells you if the move has gone too far, too fast.
Precisely. So when you combine them, you're filtering out poor signals in 2 different ways.
Give me an example.
Okay, so MACD might give you a buy signal, maybe a crossover above zero, which is great. But if the RSI is already way up above 80, the move is potentially exhausted, and you should probably ignore that buy signal.
Right.
Conversely, if RSI hits 30, which is an oversold buy signal, but the MACD is still trending strongly negative, the underlying trend momentum is just too bearish for a safe entry. So you ignore the RSI signal.
So the 86% success rate comes from only taking trades when both indicators agree.
Exactly. You're only entering when the momentum is in your favor, which is the MACD alignment, and the price is not yet overextended, which is the RSI not being extreme. You're taking fewer but significantly higher quality trades.
Okay, so why are we looking at so many ways to trade the MACD crossovers, zero, histogram? Which one is the right one for a learner to start with?
Well, there isn't a single right rule. Different rules really suit different trading personalities and objectives. For a learner, focusing on the simple zero crossover is a great starting point
Why that one?
because it clearly defines the shift between a bullish and a bearish market phase based on that relationship between the 12 and 26 period averages. It's very clear. However, if your focus is strictly on maximizing risk-adjusted returns, then the data steers you toward the signal line crossover above zero, as it's a more selective and therefore higher conviction signal.
Okay, so start simple, then add layers.
Exactly. The main takeaway is understanding that customization is possible, but you should start with the rule that best defines your desired objective.
My last question here is a big one. If combining indicators is so much better, how do I avoid getting stuck when they conflict? For example, the price is clearly above the 20-day moving average, which is bullish, but the RSI is overbought, suggesting a potential sell-off.
That is the classic moment where novice traders just freeze. It's the primary cause of analysis paralysis.
Just what do you do?
The scenario you described, price structure, says buy the dip, but RSI says sell now. It means the market is likely in a state of high volatility or consolidation, or maybe undergoing a major shift. And the best advice from the sources is incredibly simple.
What is it?
When indicators conflict, stand aside. You only trade when you have confluence, meaning all your chosen tools, price, volume, and momentum, are pointing in the same direction. If your entry signal conflicts with your momentum filter, it is not a high probability trade, period.
So no signal is also a signal, the signal to do nothing.
That's probably the most profitable signal a trader can learn.
All right, let's talk about volatility next.
Let's do it. We're moving from measuring acceleration, which is momentum, to measuring fluctuation or volatility, and that is handled perfectly by Bollinger Bands. But first, the backbone of this tool,
The moving average.
the moving average, or MA.
Moving averages seem omnipresent in trading. How do they relate to the bigger picture here?
Well, the moving average is an essential overlay that smooths price data and serves as a dynamic trend line, or dynamic support and resistance. The 20-period MA, specifically, is often used as the backbone of Bollinger Bands.
And what's special about the 20 MA?
In strong trending markets, the 20-period MA acts as an area of value. When the market pulls back to this area, it's considered a high probability opportunity to enter long or short to ride the continuing trend.
Because the price is expected to snap back to that average.
Exactly. It's expected to mean revert back to that average. So if the price pulls back to the 20 MA and bounces, that can be your entry confirmation for a trend continuation.
Okay, now the Bollinger Bands themselves.
Bollinger Bands are incredibly versatile. They consist of 3 lines. A middle band, which is usually that 20-period MA, and an upper and lower band, which are typically set 2 standard deviations away from the middle band.
And standard deviation, that's a measure of volatility.
It is, and that's the key. This means the bands dynamically adapt. They widen during periods of high volatility with rapid price movement, and they contract during consolidation or low volatility.
I hear the term Bollinger squeeze a lot. What exactly does that signify, and how do I trade it?
The squeeze is when the upper and lower bands contract sharply, signaling a period of very low volatility. Since volatility tends to expand after it contracts, the squeeze acts as a precursor to a sharp price movement or a breakout.
So it's the calm before the storm?
That is the perfect analogy. And the general rule is, the longer the contraction phase, the stronger the subsequent breakout is likely to be. However, the squeeze only signals energy, not direction. You have to wait for the price to break out and confirm the direction.
The bands also serve as dynamic overbought, oversold boundaries, right? You called it the rubber band effect.
That's the mean reversion strategy. The price tends to snap back toward the middle band, which is the mean. So if the price touches or crosses the upper band, it suggests an overbought condition and a potential sell signal.
And if it touches the lower band?
It suggests an oversold condition and a potential buy signal. This Bollinger Bands bounce strategy is most effective in ranging or sideways markets, especially when you combine it with static SR levels and clear candlestick reversal patterns.
But not in a strong trend.
In a strong trend, a touch of the outer band can simply signal strength and continuation. So, again, context is everything.
You briefly mentioned VP-VMA earlier. Since we're connecting volume, price, and moving averages, how does this more complex model relate back to the simple MACD structure?
Well, the volume moving average, or VPVMA, is essentially a sophisticated relative of the MACD. While MACD uses simple closing prices for its EMAs, VPVMA aims for a more accurate reflection of true market movement.
How does it do that?
It uses the typical price, which is the arithmetic average, the high, low, and close, and then it applies volume weighting to calculate the moving averages. This ensures that the moving average places greater emphasis on periods when trading volume was highest.
Under the assumption that high volume periods are more important.
Exactly, that they're more representative of institutional commitment. This model showed positive risk versus return value in backtesting, which reinforces the idea that volume weighting really adds analytical power, even to simple moving average concepts.
Okay, let's look at the parameters. Why use a 50-day moving average versus a 200-day? What's the practical difference in trading them?
That difference really reflects your trading horizon and the function of the MA you're using. Shorter MAs, like the 14, 20, or 50, track the intermediate-term trend and are more dynamic. They're generally used by shorter-term traders for entry and exit timing, identifying those pullbacks to the area of value.
And the 200-day.
Longer MAs, like the 200-day, establish the major trend context. These long-term MAs are often identified as key support and resistance levels for catching bigger foundational moves.
So you'd use them together.
You might. You could use the 200 MA to define the overall market bias. If the price is above it, you only look to buy, and then use the 20 MA to time your specific entry within that larger bias.
If the Bollinger Bands contract, signaling a squeeze, how do I know if the breakout will go up or down? It still seems directionally ambiguous.
You're absolutely correct. The squeeze only signals potential energy. To determine the likely direction, you have to rely on the established trend on the larger time frame.
Zoom out.
Always zoom out. Look at the general direction of the 20-period MA itself, which is the center of the band. If the 20 MA has been sloping down strongly and the band squeeze, the breakout is likely to be a downside continuation. If the overall daily chart is making higher highs and higher lows, the breakout is likely up.
Okay, so the larger structure provides the directional context.
Always.
Final question. If I use the MA to ride the trend, where exactly should I put my stop loss using the bands?
That's a great practical way to combine these indicators. The pro tip is to use the 20 MA or the outer Bollinger Bands themselves as a trailing stop loss point.
So not a static price.
Right. Instead of relying on a static price, these dynamic levels allow you to stay in the position longer during a strong trend, capitalizing on the full move, but automatically exiting if the price closes decisively outside that area of value or breaks the volatility boundary against you.
Yeah.
It's far superior to a static stop if you're trying to capture large trending movements.
Okay, that makes a ton of sense. Let's talk about putting it all together for the entry signal.
Right. Now we combine everything we've learned, trend, levels, and indicators, to determine the moment of truth, the entry signal. We're looking for that evidence of the fight between supply and demand that Hama first tracked centuries ago.
So what's the secret to finding a high probability trade setup? Is it just waiting for one of those famous candlestick patterns to show up?
Not just any pattern, and certainly not one that's formed randomly in the middle of a chart. Successful trading relies on what we call confluence, which is built on the TLS model. TLS. It's three combined elements that must align. First is the trend, T. You have to identify the market structure. Is it trending with higher highs and higher lows, or is it just ranging? Use larger time frames like the 4-hour, daily, or weekly to confirm the main market structure.
Okay, T is trend. What's L?
The level L.
Yeah.
You identify the most powerful static SR zones, trend lines, or dynamic support, like your MAs, Fibonacci ratios, or Bollinger Band boundaries.
And S must be signal.
The signal, S. You wait for a high probability candlestick pattern to form at that level. If you don't have all three, trend, level, and signal, the probability success drops significantly. A signal in the middle of nowhere is just noise.
Give us the key reversal and continuation signals we should be looking for and connect them back to the emotion behind the chart.
Okay, the three most referenced high probability signals are the pin bar, the engulfing bar, and the inside bar.
Let's start with the pin bar.
Pin bar is a reversal pattern. It's characterized by a long tail, which signifies rejection, and a very small real body. That long tail tells you there was a decisive rejection of price.
So what's happening inside that candle?
Well, a bullish pin bar with the tail pointing down means sellers drove the price down aggressively, but then buyers stepped in just as aggressively at a key support level and drove the price all the way back up to close near the open or high. It signaled that the bears were decisively rejected, suggesting the market is about to reverse away from that tail.
Okay, what about the engulfing bar?
The engulfing bar is a two-bar reversal pattern, where the second bar's real body completely engulfs the body of the preceding bar. This signals a complete high-conviction takeover. A bearish engulfing bar, for instance, shows that sellers entered with enough force to completely negate all the gains of the previous bar, indicating a strong reversal.
And the inside bar is different.
The inside bar is different. It's a narrow-range bar that's completely contained within the range of the preceding bar, which we call the mother candle. It signals indecision or low volatility, a short pause in the market fight, which often precedes powerful breakout as a continuation or, crucially, a reversal, which is a trap.
Can I use, say, an engulfing bar signal anywhere on the chart, or does it have to be at a special place?
It absolutely must occur at a key level. This is the definition of confluence. An engulfing bar forming in the middle of a price range is just meaningless noise because it has no reference point.
Like at a level.
A bearish engulfing bar that forms right at a confirmed multi-touch resistance zone, however, is an incredibly high probability signal because it confirms that sellers are defending that established price ceiling. Without the level, the signal is useless.
Speaking of traps, what exactly is a false breakout and how do I avoid trading it?
The false breakout is closely tied to stop-loss hunting. This is a tactic where big institutional players know where massive clusters of stop-loss orders are, typically just beyond obvious SR levels.
And they go after them.
They drive prices to these levels temporarily to create liquidity before reversing the price strongly in their predicted direction. A false breakout occurs when the price breaks out, triggers all those stops, and then immediately returns back through the breakout price. It's a trap for novice traders who entered immediately on the break, hoping for continuation.
So how do we avoid that trap, like with the inside bar or false breakout pattern you mentioned?
You avoid the trap by being patient, which is often the hardest part of trading. The key is to avoid entering immediately on the break. First, wait for the candle to close completely outside the SR level to confirm the break.
And second,
wait for the trap traders to exit with a loss. The inside bar false breakout pattern illustrates this perfectly. The price briefly pushes outside the mother candle, triggers all the stops, and then immediately snaps back inside. By waiting for this move and the subsequent snap back, you enter in the direction of the ultimate push, exploiting the panic of those who are trapped instead of becoming one of them.
we talked about pin bars, engulfing bars, and inside bars. Are there other powerful multi-bar patterns that help define targets?
Yes, definitely. Beyond the single candle reversal signals, we look for larger horizontal congestion patterns that help us anticipate consolidation and define price targets.
Like what?
These include double tops bottoms and triple tops bottoms, which are defined by 2 or 3 peaks or troughs at roughly the same SR level. The breakout from these patterns often has a specific price target derived by measuring the height of the pattern itself.
Can you give an example of that?
Sure. If a double bottom forms between $50 and $60, the expected breakout target is $70. You take the height, which is $10, and add it to the breakout point of $60. Additionally, patterns like triangle symmetrical, ascending, descending, and the cup and handle pattern are crucial, as they also provide calculated price targets based on their height and shape.
Which lets you set profit targets well in advance.
Exactly.
Okay, this brings us to what you called the non-negotiable part of all this.
Yes. We've spent most of our time talking about entries, but the key distinction between a novice and a seasoned trader is the focus on the exit. We have to address risk management.
I often hear that you have to prioritize the exit strategy over the entry. Why is that the non-negotiable step?
It is non-negotiable because of the mathematical asymmetry of losses. Seasoned traders recognize that recovering from a large loss requires a disproportionately enormous gain.
What kind of numbers are we talking about?
To put it in stark relief, if you suffer an 80% loss, you need a 400% price move just to get back to zero. Losing 50% requires a 100% gain to recover. The lesson is simple and brutal. Cut your losses early. That is why the exit strategy, particularly the stop loss, must be planned before the trade is ever initiated.
So let's talk practical stops. Where exactly do I put my stop loss below support? How far is safe? Should I just use a flat percentage?
A flat percentage, like risking 5% of your capital per trade, is a common protective or hard stop. It's simple, but it completely ignores the market structure.
So what's a better way?
A more robust method is placing the stop based on the market structure. For a long position, you place the stop loss just beyond a recent swing low or the established support level. You need to position it far enough away to avoid the daily noise, those minor whipsaws, but close enough to respect your maximum acceptable loss. This forces you to perform a risk-reward analysis before you even enter.
You mentioned volatility-based stops. What's ATR, and how do I calculate position size if I use ATR for my stop loss?
Okay, so ATR stands for Average True Range. It's a tool used to quantify price volatility. It helps you set an intelligent stop-loss offset, ensuring your stop is outside the zone of normal daily price noise.
How is it calculated?
The true range itself is the greatest of three measures. The current high minus the current low, the absolute difference between the current high and yesterday's close, or the absolute difference between the current low and yesterday's close. The ATR is the average of that true range, often calculated over 14 periods. If the ATR is, say, 50 cents, it means the price is moving about 50 cents on average each period.
And how does that connect to position sizing?
Position sizing, the number of lots or shares you risk per trade, is where your dollar risk is enforced. Studies show successful traders risk no more than 1 to 2% of their total capital per trade.
Can you walk me through the calculation?
Sure, let's do a simple one. First, you determine your dollar risk. If you have a $10,000 account and you risk 1%, your maximum acceptable dollar loss is $100.
Okay.
Second, you determine your stop distance. If you use the ATR method, you might place your stop 2 times the current ATR away from your entry. If the ATR is 50 cents, your stop distance is $1.
And the final step.
You calculate your position size. You just divide your maximum acceptable dollar loss, $100, by the stop distance, $1. In this case, you can buy 100 shares. This calculation ensures that, regardless of the stock price or volatility, if your stop is hit, you lose exactly 1% of your account.
So it forces you to think in terms of dollars risked instead of arbitrary peps or points.
You got it. That's the magic of money management.
And that leads to the risk-reward ratio, or RR. Is a 1 to 2 RR really enough, or should I hold out for 1 to 5 every time?
While aiming for 1 to 5 is great, a 1 to 2 is often sufficient to ensure mechanical profitability if your strategy wins just 50% of the time. The power of RR is exponential.
How so?
The source material provided a great case study showing the discipline required for a 3-to-1 RR ratio. If a trader risked $200 to win $600, that's 3-to-1. Even if they lost 7 trades and won only 3, they would still profit $400.
Wow.
Yeah. It's a $1,400 loss versus an $1,800 gain. The key is just disciplined consistency. You have to calculate the RR before you enter the trade.
And finally, the emotional side, the danger of using mental stops.
Mental stops. Deciding you'll exit if the price hits X, but not physically placing the order. They're driven by the human aversion to realizing a loss.
We just hate being wrong.
We hate being wrong. If you don't place a hard stop immediately upon entry, you will be controlled by emotion when the trade moves against you. You'll hesitate, you'll hope for a pullback, and you'll risk turning a small controlled loss into that catastrophic 80% drawdown.
So the lesson is?
Trading successfully requires a disciplined, unemotional strategy built on mathematics. Place the hard stop based on your risk plan, and then, as the saying goes, forget about your trade, and never, ever risk money you can't afford to lose.
Oh, true. Okay, let's put this all together in a final synthesis.
Right. So when you pull up a chart on Monday morning, how do you apply all these moving parts? It means adopting a structured hierarchy for analysis, the TLS model we talked about.
Okay, let's unpack this TLS model again and tie it back to the whole process.
The TLS model gives you a disciplined, unemotional checklist for finding high-probability setups. First, determine the trend, T. Is the market making higher highs and higher lows? Use the daily or weekly charts to establish this direction.
Second, the level.
Second, find the key level, L. Where are the major support resistance zones, the dynamic MAs like that 20 MA area of value, or the important Fibonacci retracement ratios?
And third, wait for the signal.
Third, wait for the signal S. Wait for one of those high-probability candlestick patterns, the pin bar, the engulfing bar, or confirmation from your MACD or SI confluence to form at that level.
And we have to emphasize multiple time frame analysis here, right? Because a small signal on a tiny time frame might be running straight into a brick wall.
That is absolutely vital. That first step, determining the trend on a larger time frame, is crucial to avoid being trapped.
Ah.
A bullish pin bar signal on an hourly chart is totally meaningless if it's forming directly into a massive, confirmed weekly resistance level.
The larger time frame is your map.
It provides the context and helps prevent those low probability entries that just run directly into an established structural barrier. Always zoom out first.
This has been a truly comprehensive deep dive, moving from the most basic candlestick concepts to data-backed indicator combinations and advanced risk structures. I'm going to summarize what I actually learned today in a simple 10-point checklist. This is the blueprint for a beginner moving toward intermediate mastery.
I love it. Lay on us the essential blueprint.
Okay. Here is the beginner to intermediate 10-point trading checklist derived entirely from our discussion and the sources.
Let's hear it.
Number 1. Determine the trend on the larger time frame, T. Visually check if the market is trending, higher lows or lower highs, using the 4-hour daily or weekly charts. And avoid choppy markets.
Crucial.
Number 2. Identify key levels, L. Draw SR zones, not lines, your MAs, and key trend lines. Look for the SR flip.
Good.
3. Wait for a pullback or retest. Never chase the impulsive move. Wait for the price to retreat to a key level, especially after a breakout, before you even consider an entry.
Patient space.
4. Compare volume for confirmation, VPA. Confirm the trend by comparing high volume during the impulsive move against weak, small volume during the retracement, and compare it against the recent volume average.
Right.
5. Check for confluence, TLS. Is the price at a level moving with the trend and showing a strong signal? If not, stand aside.
It's the core of the strategy.
6. Use oscillators for status. Use RSI and MACD to confirm momentum and overbought, oversold status, filtering out weak signals. 7. Watch the squeeze. If Bollinger Bands contract, anticipate a powerful move, but rely on the overall larger trend direction for your bias.
The coiled spring.
8. Always calculate risk-reward before entering. Aim for at least 1 to 2, ideally 3 to 1, to ensure mechanical profitability.
The math has to work.
9. Limit position sizing. Limit risk to a fixed dollar amount, no more than 1 to 2% of your capital per trade. Calculate your size based on the distance to your stop loss.
Protect your capital.
And finally, number 10. Place a hard stop loss. Immediately place a static stop loss using SR or an ATR multiple upon entry to avoid emotional, catastrophic losses. Never rely on mental stops.
That is a phenomenal synthesis. It captures the full structure of technical mastery. The power of technical analysis when you distill it to these basics is that the market is fundamentally driven by human emotion, fear, and greed. And history tends to repeat itself.
It's all just patterns of human behavior.
It is. And even the most complex indicators and strategies we touched on, like the price-volume moving average, are fundamentally built on these core concepts of messy D and volume weighting, which just validates the importance of mastering the basics first.
Mastering the basics, practicing discipline, and always prioritizing the exit strategy.
Exactly. And that leads to one final provocative thought for you to consider. In our backtesting results, strategies built on combining indicators like messy D and RSI showed the best risk-adjusted performance, meaning they provided the most sustainable, least volatile returns. However, one of the simpler, less filtered strategies, the ANK-CD crossover above zero, sometimes provided the highest accumulated raw profit, even though its risk metrics were poor.
So bigger gains, but a much bumpier ride.
Much bumpier ride. And this raises the question all traders must eventually answer. Are you optimizing your strategy purely for the highest raw returns, chasing the biggest number and accepting higher volatility, or are you optimizing for sustainable, risk-adjusted growth? Because those two objectives are not always the same.
A perfect thought to take into the charts and onto your trading desk this week. Thank you for diving deep with us. We'll see you next time on the Deep Dive.